Welcome to The Explainer. Today, we're diving into a really fascinating clash that happens in pretty much every single business. We're talking about the collision between rigid, mechanical accounting systems and, well, unpredictable human psychology.
So here's a paradox basically every financial professional has to face at some point. Why exactly do smart budgets make people do dumb things? I mean, organizations literally spend months crafting these perfect financial targets, right? But instead of inspiring greatness, these rigid targets often accidentally destroy performance. You see managers hiding money, salespeople delaying closing their deals, and long-term growth completely sacrificed just to hit a quarterly bonus. Today, we're going to figure out exactly why this happens and, more importantly, how to fix it.
Here is our roadmap for today. First, we'll look at management control systems. Then, the human side of budgeting, dysfunctional behaviors, the controllability principle, and finally, how we balance systems with people.
Let's get right into Section 1, Management Control Systems.
Think of these control systems kind of like a timeline. Before the action even happens, we use what's called feed-forward control. This is all about anticipating problems, like setting up a budget before the year even starts. Then, during operations, we have concurrent control, which actively monitors the process while it's actually happening. And finally, after the fact, we rely on feedback control, where we measure our actual results against the plan we made, typically through variance analysis.
So, it essentially boils down to this really simple equation. Control equals feed forward, before, concurrent during, and feedback after. It's a beautiful, completely logical framework. But, as we all know, a system is really only as good as the people operating it.
Which brings us to Section 2, the human side of budgeting.
Now, there's a pretty stark contrast between the two main ways we go about setting a budget. On one side, you have participative, or bottom-up budgeting. This is where you actually ask the team what their targets should be. This creates fantastic ownership, higher commitment, and great morale. But the downside? It is incredibly slow, and it invites people to set super easy targets for themselves. On the flip side, we have imposed, or top-down budgeting. This relies on the head office just dictating the numbers. It's wonderfully quick, it aligns perfectly with corporate strategy, but the staff have absolutely zero buy-in. And honestly, it can be highly demotivating because those targets might feel completely unrealistic to the people on the ground.
So, as you can see, there is absolutely no perfect one-size-fits-all system here. As performance management pros, we are constantly forced to trade off between the efficiency of that top-down strategy and the motivation of bottom-up reality. And when that balance is off, well, things start to get weird. Moving on to Section 3, Dysfunctional Budget Behaviors.
Okay, so when these performance metrics are poorly balanced, we start to see a whole lineup of what is basically corporate sabotage, driven purely by the metrics themselves. First up is gaming. This is when a manager accelerates sales or delays necessary expenses just to hit a specific bonus threshold by the end of the month. Then there's smoothing, where earnings are manipulated to look perfectly stable to the outside world, totally masking the reality of the situation. But the most dangerous one might actually be short-termism. This happens when desperate managers cut vital, long-term investments, things like R&D, staff training, or machine maintenance, literally just to boost today's profit. And finally, we have budgetary slack.
Let's zoom in on that last one. Budgetary slack is essentially just padding the budget out of self-preservation. Employees deliberately overestimate how much a project will cost, or underestimate the revenue they think they can bring in, just to guarantee they hit their targets. Why? Because they fear that if they set an aggressive target and fail, they'll lose their bonus, or even worse, face budget cuts next year. It creates these massive inefficiencies because the organization suddenly has all this hidden capacity it doesn't even know about. And that brings up a huge foundational truth we have to remember. Budgeting influences behavior, period. If your employees are gaming the system or hoarding resources, it's not just a people problem, it is a system design problem. We need a smarter approach to design, one that motivates people without forcing them to manipulate the numbers. All right, Section 4, the controllability principle.
This right here acts as the ultimate fairness rule. The controllability principle states that managers should only be evaluated on costs, revenues, and assets that they can actually control. Holding someone accountable for an expense that is completely outside their power to change, that instantly destroys the integrity of your entire management control system. It breeds resentment, and it absolutely guarantees demotivation. So, when you're drawing the line during a performance review, making these distinctions is critical. Direct material and labor costs, those are controllable. The manager can negotiate with suppliers, they can reduce waste, or they can manage the schedule. But what about apportioned head office rent or central marketing? Non-controllable.
A divisional manager literally cannot do anything about the fancy downtown rent the CEO decided to sign a lease for. Forcing that allocated cost into a divisional review is just inherently unfair. You absolutely must exclude these arbitrary allocations.
Think of this as your golden rule for system integrity. Evaluate only on items a manager can actually influence and strictly exclude those allocated costs. Following this mandate protects your managers from feeling like the whole system is just rigged against them.
And finally, Section 5, Balancing Systems and People.
So what's the solution? Well, it's a blended best practice procedure that kind of gives you the best of both worlds. Step 1 requires strategic direction from the top, where executives set the big vision and the ultimate goals. Step 2 requires operational input from the bottom, where the people actually doing the work provide realistic estimates of what it takes to get there. And Step 3 is to review and negotiate. This dialogue right here is where the magic happens. It successfully integrates the efficiency of that top-down strategy with the deep commitment of bottom-up participation.
As we wrap up today, I want you to consider your own workplace for a second. Are your performance metrics actually inspiring greatness, or are they just encouraging a better game? If your system relies purely on strict feedback control without any participative input or fair controllability, you might just be teaching your team how to hide their mistakes better. So design measures that actually matter, align them with your strategy, and always manage the behavior. Thanks so much for joining me on this explainer, and I'll catch you next time.
Welcome back to The Explainer. Today, we are opening up a seriously fascinating toolkit from the ACCA Performance Management Frameworks. We're going to be breaking down the actual logic behind relevant costing, shutdown decisions, and that classic make or buy dilemma. Let's dive straight into the source material and see exactly how top-tier strategists avoid those classic accounting traps.
Here's our game plan for today. We're going to run through the golden rules of costing, identifying relevant costs, making the tough shutdown decision, the make or buy dilemma, avoiding the scarce resource trap, and finally, a quick decision maker's summary. All right, let's jump right into part 1, the golden rules of costing. Before you make any short-term business decision, you absolutely have to get your costs sorted correctly. And a relevant cost basically rests on 3 critical pillars. First up, it has to happen in the future. Anything in the past is already gone. Second, it needs to be an incremental cash flow, which just means actual cash is either entering or leaving the business. And third, it has to change based on the choice you make. If a cost stays exactly the same, whether you say yes or no, well, it's just noise. You've got to ignore it. The source material actually distills this perfectly into one golden rule. Relevant equals future cash flow that changes with the decision. Seriously, lock that into your memory. It is your absolute ultimate filter for looking at any financial data. Moving on to Section 2, identifying the relevant costs. So how exactly do we filter the signal from the noise? Well, think of it like this separation. On the relevant side, we care about future cash outflows, opportunity costs, and avoidable fixed costs. But on the other side, that is the danger zone. Sunk costs, they're already gone. Ignore them completely. Depreciation? That's just an accounting illusion. No actual cash is moving. And here is a massive trap you need to watch out for. Idle labor. If your workforce is already being paid to just sit around, putting them on a new project costs you exactly 0 extra cash. Don't let that trick you. Okay, part 3, making the shutdown decision. Now let's play defense. Imagine one of your divisions is just bleeding money on paper. The high-stakes question becomes, should we shut it down? I mean, your gut instinct probably screams cut your losses, right? But we actually need an exact mathematical flow here to avoid falling for red herrings. The framework gives us a step-by-step battle plan for this. Step 1, calculate the lost contribution. Step 2, calculate the fixed costs you actually save. And pay close attention here. Only avoidable fixed costs matter. Things like apportioned head office rent, you're stuck with that either way. Step 3, consider any closure or redundancy costs. And finally, Step 4, compare those true cash savings against the contribution you're losing. Let's put some numbers to this with an example straight from the source. Imagine a product line generates £50,000 in contribution. If we pull the plug, boom, we lose that $50,000. But on the flip side, what are we actually saving? Let's say it's only £40,000 in avoidable fixed costs. Do the math there. Shutting down to save $40,000 actually costs you $50,000 in lost contribution. You would literally be £10,000 worse off by shutting down. Crazy, right? Which brings us to our second big takeaway. Shut down if and only if avoidable cost savings are greater than the lost contribution.
If the savings don't beat the lost contribution, keep those doors open. Let's flip the script. Section 4, to make or to buy. We are pivoting from defense to offense now. Do we produce a component internally, or do we just outsource it and buy it externally? The core comparison here pits your total internal relevant cost against the external purchase price. But notice something absolutely crucial. The internal cost isn't just your materials and labor. It's the variable cost plus any opportunity cost. If you've got spare capacity, great, opportunity cost is 0. But what if you don't? That question leads us perfectly into Section 5, the scarce resource trap. This is where things get really interesting, and it's a huge trap in the source material. What happens when your internal resources are totally maxed out? Think about it. If your internal labor force is fully occupied building highly profitable products and you pull them away to make a new component, you are destroying contribution somewhere else. That destroyed contribution, it becomes a hidden penalty. Let's reveal that hidden penalty from our specific scenario. The source notes describe a product where labor currently earns a contribution of 3 pounds per hour, and this new component we want to make takes 2 hours. So, 3 pounds an hour times 2 hours equals a 6-pound hidden penalty. That 6 pounds is your opportunity cost. It's the very real cash you are giving up just to make the component in-house. Now watch how this scarce resource totally flips the decision on its head. Let's say the standard internal variable cost is 8 pounds, and buying it externally costs 10 pounds. At first glance, you're thinking, obviously we make it for 8. But hold on. Because labor is at full capacity, we have to tack on that 6-pound opportunity cost. Suddenly, our true internal cost skyrockets to 14 pounds, meaning that 10-pound external price is actually a total bargain. It's the clear winner. So the framework gives us this golden rule. Make it internally if the relevant cost is less than the external price. Otherwise, buy it. Just never, ever forget to include the opportunity cost if your resources are scarce. All right, let's wrap this all up. Section 6, the decision maker's summary. It's time to bring all these frameworks together into one powerful strategic checklist. First, you've got to base short-term decisions only on future incremental cash flows. Second, ruthlessly ignore sunk costs and unavoidable fixed costs. Third, shut down only if the avoidable savings actually beat the lost contribution. Fourth, always check for opportunity costs if your resources are scarce. And finally, outsource if the external price beats your true internal relevant cost. Which leaves us with one final incredibly important question. Are sunk costs and hidden opportunity costs clouding your next big business move? Because once you start applying these ACCA PM tools, you can cut right through the noise and see the right decisions with absolute clarity. Thanks so much for hanging out with me for this explainer, and I'll catch you next time.
All right, welcome to this explainer. Today we're strapping in for a really high-yield coaching session focused squarely on 2 of the biggest, absolutely most critical profit-driving decisions in the ACCA Performance Management syllabus. We're talking about resource scarcity and pricing strategy. Look, if you want to conquer the PM exam and, let's face it, just survive the syllabus, you really have to know how to maximize profit when the odds are completely stacked against you. And you need to know exactly how to price your products to capture maximum value. Okay, let's dive right into this.
So, here's our game plan for today. First, the profit maximization problem. Second, limiting factors and linear programming. Third, pricing decisions looking at both demand and cost. And finally, exam tricks and execution to make sure you actually secure those marks.
Section 1. The profit maximization problem. What to make and what to charge. You know, in a perfect world, a business has infinite resources and infinite demand. But we operate in a reality that's governed by constraints. Driving profit isn't just about selling more stuff. It's about optimizing the very specific variables you actually have control over when everything else is restricted. So I want you to think about this question for a second. What do you do when you run out of labor or materials? Imagine your customers are practically knocking down the door, but your factory only has 100 hours of machine time available this week. Or maybe a global supply chain issue means you only have 50 kilograms of a really crucial raw material. How do you decide which products get made and which ones just get left on the cutting room floor? This right here is the classic problem of bottlenecks.
Which brings us to Section 2, limiting factors and linear programming, conquering resource constraints.
This is where we conquer those constraints, using pure math and strategic logic. When you hit a bottleneck, your entire production strategy has to pivot. You're no longer just looking at what makes the most money overall. You are looking at what makes the most money relative to the exact thing that is holding you back. If you remember only one single thing from this entire explainer about single limiting factors, please let it be this golden rule. Maximize contribution per unit of bottleneck resource. Notice we are not maximizing profit per unit. No way. We're maximizing contribution per unit of the bottleneck. So, if machine hours are holding you back, you want to produce the item that gives you the absolute highest contribution for every single hour that machine is running.
Okay, let's break this down into the exact step-by-step flow you're going to need for the exam. Step 1, identify the limiting factor. Is it labor? Is it materials? Step 2, calculate the basic contribution per unit for each product. Remember, that's just selling price minus variable cost. Step 3, calculate the contribution per limiting factor. This basically means dividing the unit contribution by the amount of the scarce resource it actually takes to make one unit. Step 4, rank them. The highest contribution per limiting factor gets rank number 1. And finally, step 5, allocate your scarce resource to the highest rank until it's entirely used up. Now pay super close attention to step 4. The single most common mistake here is ranking by contribution per unit. Don't do it. Always, always rank by the bottleneck.
But what happens when the real world gets even messier? What if you're short on labor and you're short on materials at the exact same time? Well, when a company faces more than one constraint like that, the simple ranking method totally breaks down. We have to level up our strategy to linear programming.
Now, I know linear programming might sound a little intimidating. It's usually the part of the syllabus where everyone suddenly hates math. But trust me, it follows a really logical 4-step process. First up, you identify your constraints and translate them into mathematical inequalities. Second, you formulate your objective function, which, by the way, is always to maximize total contribution. Third, you solve the problem. You can do this either graphically by drawing out the constraints or algebraically using simultaneous equations. And fourth, you identify the optimal production mix. The really crucial point to remember here is that your optimal production point is almost always going to lie at the exact intersection of your constraint lines on a graph. That intersection is the sweet spot where you're maximizing both scarce resources simultaneously.
Moving right along to Section 3, Pricing Decisions, Setting the Perfect Price Tag. All right, so we've optimized the production floor, but now we've got to optimize our sales. Creating the right product mix is really only half the battle. Setting the perfect price tag is what actually captures the profit. We need to look at this from two different angles, demand and cost. Let's start with demand-based pricing, which is entirely driven by customer sensitivity. We measure this using price elasticity of demand, or PED. If demand is elastic, it means your customers are highly sensitive. You raise the price even a tiny bit, and demand drops significantly. But if demand is inelastic, your customers are super loyal, or maybe the product is just an absolute necessity. In that case, you can raise the price, and demand will only drop a little bit. Understanding your PED completely dictates your entire pricing strategy.
Now, when you're using demand-based pricing, there is an absolute, undeniable mathematical rule for finding that perfect profit-maximizing price. It's the optimal output rule, MR equals MC. Marginal revenue must equal marginal cost. Seriously, if the revenue you get from selling one more unit is exactly equal to the cost of making that one extra unit, you have hit the absolute peak of your profit curve. Burn this rule into your brains, folks.
To actually find that MR equals MC point, you're often going to have to work with the linear demand curve equation, P equals A minus BQ. A is the price where demand hits 0, and B is the change in price divided by the change in quantity. Remember that total revenue is just price times quantity. The exam is very often going to give you this exact demand equation and ask you to calculate the optimal price point by deriving the marginal revenue and setting it perfectly equal to your marginal cost.
Okay, let's flip the script and contrast that with cost-based pricing. This is a lot simpler, but, it comes with some serious trade-offs. The two main methods here are full cost plus and marginal cost plus. Full cost plus is highly advantageous because, well, it's simple and it guarantees all your costs are covered. But its massive disadvantage is that it completely ignores what the customer is actually willing to pay. It totally ignores demand. Marginal cost plus, on the other hand, is absolutely brilliant for short-term special orders where you just want to generate a little extra contribution. But it's pretty dangerous long-term because it might just fail to cover your fixed overheads.
And this really brilliantly illustrates the mechanical difference between the two. Full cost plus takes your full cost per unit, so that's variable plus fixed overheads, and adds a percentage markup. It puts a markup on literally everything. Marginal cost plus only takes the variable marginal cost and adds a markup, which effectively serves as your contribution. So as a quick rule of thumb, full cost plus is your baseline for standard pricing, while marginal cost plus is your absolute go-to strategy for short-term, one-off special orders where you happen to have some spare capacity.
And that brings us to Section 4, Exam Tricks and Execution, Avoiding the Traps.
All right, we are in the final act here. You understand the theories of limiting factors and pricing, but actually passing the PM exam, that is all about execution. It's about knowing exactly where the examiner sets the traps and knowing exactly how to step right around them. Let's do a rapid-fire review of the absolute most common pitfalls. First up, ranking. I'm going to say it again. Always rank by contribution per limiting factor. If you rank by contribution per unit, your entire calculation is going to be wrong. Second, linear programming graphs. You absolutely must be comfortable drawing break-even and LP graphs using these specific computer-based exam or CBE tools. Please practice this before exam day. Third, for special pricing orders, if the scenario tells you there is spare capacity, immediately think of marginal cost plus. And finally, the most important exam technique of all, method marks. Show absolutely all of your workings. I literally cannot stress that enough. In the PM exam, method marks are a total lifesaver. Even if you mess up some early calculation and your final number is totally wrong, the examiner is going to follow your logic. If your logic and your steps are correct, you will still earn the vast majority of the marks.
Which brings us to our final thought. You know the models, now apply them. Performance management isn't just about memorizing some formulas, it's really about applying them to realistic business scenarios to make critical, strategic decisions. You now have the exact tools to handle resource scarcity and to set those optimal prices. But I want you to ask yourself this. If a major competitor slashes their prices tomorrow, do you know exactly how your profit margins are going to survive the impact? Trust these frameworks, show your logic clearly on the exam, and you are absolutely going to crush it. Thank you so much for joining me for this explainer.
Hey, welcome to this explainer. Today, we're cracking the code on advanced performance management variances.
Are your basic variances lying to you? Short answer, yes. They totally hide the real story.
So let's fix those blind spots right now with advanced variances that show true business performance.
First up, mix variance. This compares the actual versus the standard proportion of your inputs.
Mix variance is literally just about the proportion of inputs you used. Now, yield variance. This looks at the actual output you managed to get from total inputs.
Think of it like this. Mix is the input proportion, but yield, that's all about total output. Like if 500 kilos should make 100 units, but only makes 90. That's 10 units adverse.
Which brings us to a huge exam trap. Would you punish a manager for a market crash?
No way. The golden rule is controllability. Only judge them on stuff they can actually influence.
So we have to separate the original budget, the new market reality, and what actually happened. Step 1 gives us the planning variance. Step 2, that calculates the manager's operational variance.
Planning variance measures uncontrollable market factors. It basically highlights when the original standard was just unrealistic.
If a material price unexpectedly jumps from 5 to 6 pounds, that 1 pound adverse is uncontrollable. But operational variance? That strictly measures a manager's actual, controllable performance against that revised standard. If they paid £6.20 against a revised £6 standard, that 20 pence is on them.
Don't fall for this exam trap. Planning is strictly uncontrollable, but operational is totally controllable.
Here's a quick cheat sheet. Memorize these one-line triggers right now. They're absolute lifesavers.
Avoid deadly mistakes. Never mix up planning and operational. And always compare actual to standard yield. Separate the uncontrollable from the controllable. But tell me, will you recognize these traps on exam day?
Welcome to The Explainer. Today we're cracking open the source material on advanced performance management, specifically zeroing in on the ACCA PM syllabus. We're looking at the actual rules of the game when it comes to corporate finance, how massive organizations control their money and, well, their people. It's a really fascinating look at strategy, psychology, and this incredibly delicate balancing act. Now, I want you to really think about this for a second. How do you price a product when the buyer and the seller are technically the exact same company? And, maybe even more universally, how do you stop managers from intentionally hiding secret cash or padding their numbers? Well, we're going to skip the boring agenda today and jump right into this clash of human nature versus corporate control. Let's get moving. Section 1, the internal price tag. Let's dive straight into a core concept of the ACCA PM syllabus, transfer pricing. Simply put, it's the price charged when goods or services are transferred between divisions within the exact same corporate group. Imagine you're the manager of Division A, right, a manufacturing plant, and you're selling your finished parts to Division B, the assembly plant down the street, which happens to be owned by the exact same parent company. Now, obviously, you both want your own division to look highly profitable, so what on earth do you charge your own colleague? Well, you can't just pick a number out of thin air. The transfer price has to land somewhere between an absolute floor and an absolute ceiling. The minimum price is the variable or marginal cost of the supplying division. I mean, you can't sell it to your colleague for less than it cost you to physically make it, right? That just doesn't make sense. On the flip side, the maximum price is the external market price. The buying division isn't going to pay you more than they'd pay an outside vendor on the open market. So the final price? It has to land right in that sweet spot between the two. So here is your cheat code. The transfer price range equals variable cost to market price. If you just understand this golden rule, you immediately understand the mathematical boundaries of all internal corporate sales. Section 2, Strategic Transfer Pricing Goals. Headquarters isn't just watching Division A and Division B argue over price for fun. No, they have 4 massive, often completely conflicting strategic goals. First, they want divisional autonomy. They want managers to feel like real CEOs running their own show. But second, they need global tax efficiency. If Division A is in a low-tax country and Division B is in a high-tax country, well, headquarters might want a higher transfer price to shift profits to that low-tax jurisdiction. Third, the price must motivate managers so they actually want to hit their targets. And finally, they absolutely must avoid suboptimization, which is really just a fancy way of saying they can't let a division make a decision that's great for them, but terrible for the company as a whole. You can literally feel the immense friction here. So the crucial point you should take away is this. Transfer pricing equals balancing divisional autonomy, tax, performance, and motivation. It is the ultimate corporate tightrope walk. You tweak the price to save on taxes, and suddenly your managers are totally demotivated. You give them total autonomy, and suddenly you're bleeding cash on the global market. All right, Section 3, Building the Corporate Budget. Setting a budget is definitely not a one-size-fits-all kind of deal. In the ACCA PM framework, we actually see 2 completely different approaches. A fixed budget is, well, exactly what it sounds like. It remains totally unchanged regardless of your activity level, and it's fantastic if you operate in a highly stable, predictable environment. But what if things change? That is exactly where the flexible budget comes in. A flexible budget actually adjusts for the actual activity volume. If you want to evaluate a manager's performance fairly when market volumes are fluctuating wildly, a flexible budget is absolutely your best tool. It tells you what the cost should have been for the actual level of output. And how do you actually build the numbers inside that budget? Well, here is the classic battle between convenience and efficiency. Incremental budgeting is the old school approach. You take last year's numbers, slap a percentage increase on them, and call it a day. It's incredibly quick, it's stable, but it has a massive flaw. It just perpetuates last year's inefficiencies. You're basically just kicking the waste down the road. The alternative is zero-based budgeting, or ZBB. Here, every single budget cycle starts from absolute zero. You have to justify every single item of expenditure. It's incredibly efficient at stripping out waste, but as you might guess, it's really time-consuming to pull off. Then we get into the pure psychology of management. Like, who actually writes the budget? A participative or bottom-up budget asks the lower-level managers to prepare their own targets. This creates fantastic ownership and way higher commitment. But, and it's a really big but, it allows managers to build in easy targets, something called slack. Conversely, an imposed or top-down budget is dictated straight from senior management. It's incredibly quick and aligns perfectly with corporate strategy, but man, it can be horribly demotivating for the team on the ground. The reality? Best practice is almost always a blend. Strategic direction from the top with operational input from the bottom. Which brings us to Section 4, the budgetary slack trap. Budgetary slack is the intentional, deliberate act of overestimating your costs or underestimating your revenues to make the budget easier to achieve. In plain English, it's padding. And honestly, it is basic human nature. If your boss asks you how long a task will take and you know it takes 2 days, you might say 3 days just to give yourself a nice little cushion. While managers do the exact same thing, just with millions of dollars.
Now, what's really fascinating here is the psychology driving this behavior. Why do they pad the budget? Usually, it's driven by two very powerful motivators: greed and fear. Greed, because they often have performance-related bonuses tied directly to hitting these targets. And fear, because they worry that if they show how efficiently they can really work, headquarters will just instantly slash their future budgets. But look at the disadvantages for the company. It creates entirely inefficient resource allocation and leaves the organization with massive hidden capacity. Headquarters thinks they're maxed out, but the decisions are actually sitting on tons of untapped potential. So, how does headquarters fight back and squeeze this slack out of the system? They have a few strategic steps they can take. First, implement zero-based budgeting, which we talked about earlier. If you force managers to justify every single dollar from zero, the padding gets exposed pretty quickly. Second, compare their actual numbers to external industry benchmarks. If your division is spending, say, 20% more on logistics than your direct competitors, headquarters knows for sure there's slack hidden in there. And third, relink their performance bonuses to realistic, challenging targets rather than easily manipulated budget lines. The core takeaway here is simple. Budgetary slack equals intentional padding, and it completely reduces efficiency. Budget gaming might protect an individual manager's bonus, but it actively hurts the entire organization. Section 5, beyond traditional budgeting. So, given all these issues, some companies are just throwing out the old rulebook entirely. It's an approach literally called beyond budgeting. And the core premise? You completely abandon the traditional fixed annual budget. Instead, you rely on continuous rolling forecasts and key performance indicators, or KPIs, to manage the business. The ultimate goal here is to create a highly adaptive, decentralized system driven by purpose and values, rather than rigid financial targets set 12 whole months in advance. Let's balance the scales one last time. The advantages of beyond budgeting are frankly phenomenal. It makes the company incredibly adaptive to rapid market changes. It massively reduces that gaming and budgetary slack we just talked about, mostly because there's no fixed annual target to game in the first place. And it encourages continuous improvement. But look at the disadvantages. It requires an incredibly mature management culture to pull off. You need high trust. And the hard reality? External stakeholders like banks and investors, they still expect to see traditional budgets. They want those hard, predictable numbers. So here is your final golden rule for the day. Beyond budgeting equals no fixed annual budget. Instead, it's rolling forecasts, KPIs, and being highly adaptive. It really is a massive paradigm shift in performance management. Which leaves us with this final provocative thought. If traditional budgeting inevitably creates so much padding, gaming, and inefficiency, is it time for your organization to just blow up the annual budget completely? I know, it's a terrifying thought for accountants, but a deeply fascinating one for modern management. And that wraps up our explainer on ACCA PM transfer pricing and budgeting. I really hope this structured look clarified the rules of the game for you. Keep analyzing, keep questioning those numbers, and we'll catch you in the next explainer. Welcome to the Explainer. Today, we're diving into the ACCA PM syllabus, tackling financial versus non-financial performance measures. Sounds crazy, right? But seriously, relying on the wrong performance metrics can literally destroy your company's value. Take ROI, for example. You just divide controllable profit by investment to get a simple percentage. But watch out for the ROI trap. Managers might actually reject great projects just to protect their percentage. A much smarter fix? Residual income, or RI. It subtracts your cost of capital straight from the profit. Notice the big difference here. ROI chases a flashy percentage, while RI focuses on hard, absolute cash. Because it uses absolute dollars, ROI perfectly aligns your manager's choices with the company's overall goals. But here's the harsh truth. Purely financial metrics are totally backward-looking, making you dangerously short-sighted. Enter the balanced scorecard. It's a brilliantly holistic framework by Kaplan and Norton that completely fixes this. It balances financials by adding 3 vital areas: your customers, your internal processes, and learning and growth. It's pure cause and effect. Better learning creates smoother processes, which absolutely thrills customers and ultimately boosts your profits. Basically, these non-financials act like early warning systems, predicting your bottom line success way before it actually happens. Finally, let's zoom out to external benchmarking. How exactly do you stack up against the rest of the world? You can benchmark internally against your direct rivals or functionally against the absolute best in any industry. To nail this, you just identify your target, pick a partner, gather that data, and analyze the gaps. So, look at your own business. Are you trapped by basic ROI or measuring what truly matters?
All right, welcome to this explainer. Listen, if you're an ACCA PM student getting ready to sit for your exam, I need you to grab your coffee, sit up straight, and tune in. Seriously, we are bringing absolute, highly caffeinated energy to your revision today. We're going to lock in some incredibly easy exam marks by attacking two of the examiner's absolute favorite topics. You probably already know the models, right? But today, we're going to learn how to actually apply them efficiently, and more importantly, dodge those traps that cost students their passing grades.
So here's our game plan for today. First, cracking throughput accounting. Second, the T-PAR decision rule. Third, environmental management accounting, or EMA for short. And fourth, the 4 types of environmental costs. These are 2 massive topics, and we are going to absolutely crush them.
Okay, let's dive right into this. Section 1, cracking through throughput accounting and beating the bottleneck.
Look, in literally any manufacturing process, there is always a bottleneck, right? It's that one slow machine or process that completely limits your total output. Throughput accounting is all about maximizing your profit around that single limiting factor. But to really get this, we have to look at the absolute core definition. Throughput is simply your sales revenue minus your direct material cost. That's it, nothing else. In the world of throughput accounting, we make this huge, absolutely crucial assumption: only direct material is considered truly variable. Every single other factory cost, rent, electricity, and yes, even the people working the machines, it's all just lumped together as a fixed total factory cost in the short term.
Now stop whatever you're doing and pay attention to this, because this is the ultimate exam trap. I'm telling you, do not fall for this. The examiner is almost certainly going to give you a direct labor cost per unit and try to tempt you into deducting it from your sales revenue. No way. Remember, in throughput accounting, labor is fixed in the short term. Do not treat it as a variable cost. If you subtract labor when calculating throughput, you are going to lose those marks instantly. Just don't do it. Only deduct material, period.
So, how do we actually tackle a calculation question when it pops up? Well, here is your golden 5-step roadmap. Memorize this exact sequence. Step 1, identify your bottleneck resource. You know, which machine is actually slowing everything down. Step 2, calculate the throughput per unit for each product. Remember, that's just sales price minus material cost. Step 3, calculate the throughput per bottleneck hour. This is so vital because you want to know exactly how much profit you're generating for every precious hour spent on that slow machine. Step 4, rank your products from highest throughput per hour all the way down to the lowest. And finally, Step 5, allocate your scarce bottleneck hours to your #1 ranked product first until demand is met, and then just work your way down the list. If you follow these steps, honestly, you cannot go wrong. All right, moving right along to Section 2, the T-PAR decision rule, the formula for profit. So this brings up a really good question. How do we actually know if a product is truly profitable under throughput accounting? I mean, think about it. How do we know if a product is worth making when we're only looking at material costs? We still have an entire factory full of fixed costs to pay for, right? We need a specific metric to tell us if our throughput is actually high enough to cover all those overheads and, actually generate a profit. Well, the solution is the throughput accounting ratio, or T-PAR for short. Here's how it works. You take your throughput per bottleneck hour and you divide it by your total factory cost per bottleneck hour. It's like a giant balancing act. You're essentially comparing the exact rate at which you generate cash against the rate at which you spend cash on your factory overheads. The ultimate goal here is always to maximize your throughput per bottleneck hour to make absolutely sure it outweighs those fixed factory costs. And that brings us to the absolutely crucial point, the decision rule. Your T-PAR must be greater than 1. Seriously, scream this rule from the rooftops. If the T-PAR is greater than 1, the product is profitable, boom, done. It literally means you're generating cash faster than you're burning it. But if it's less than 1, oh boy. You are losing money every single time that bottleneck machine ticks over.
Let's violently hammer this concept into your short-term memory with a brilliant one-line summary from our revision notes. Throughput equals sales less material. Maximize per bottleneck hour. Seriously, if you take absolutely nothing else away from this topic today, remember that single sentence. It's the whole shebang. It contains the formula and your ultimate objective all in one perfectly wrapped package.
Okay, take a deep breath and let's quickly reset, because we are diving into Section 3, Environmental Management Accounting, or EMA, making costs visible.
We are completely pivoting here to our second boss battle, a topic that blends hard financial metrics with corporate responsibility.
See, the traditional problem with environmental costs, stuff like waste disposal or emissions compliance, is that they're usually totally hidden. They just get dumped into this massive, generic, general overhead bucket. And because of that, management has literally no idea which specific products are actually causing the damage. Well, EMA completely changes the game. It identifies these environmental costs and aggressively allocates them to the specific products or processes that actually generated them. Basically, it makes the hidden costs visible so management can finally step up and make smart, targeted decisions.
Now, you might be wondering, how do we actually do that allocation in a real exam question? Well, here is your ultimate exam trick. You use activity-based costing, or ABC. You allocate these environmental costs using specific cost drivers. So instead of allocating waste disposal costs based on something totally arbitrary, like, say, labor hours, you allocate them based on the actual kilograms of waste a product creates, or maybe the liters of effluent it pumps out. This method heavily penalizes the dirty products and for sure accurately reflects their true cost to the business.
All right, let's bring it home. Section 4. 4 types of environmental costs. Categorize to win. To totally master EMA, you must be able to perfectly categorize environmental costs into proactive and reactive management buckets. First up, we have prevention costs. This is stuff like buying equipment to reduce emissions before they even happen. Second, we have detection costs. Things like testing and monitoring, just to ensure you aren't polluting. But then, things go wrong, right? That's internal failure. It means the pollution happened, but luckily you caught it inside your factory. Think cleaning up a spill or paying for safe waste disposal. And finally, the absolute worst-case scenario, external failure. The pollution actually escaped into the world, resulting in severe government fines, massive lawsuits, and a completely devastating loss of reputation. Notice a trend here? Investing early in prevention is always cheaper than paying for a massive external failure down the line.
To anchor this entire topic in your mind forever, we have our second one-line summary. EMA equals making environmental costs visible for decisions. It really is that simple. Pull the costs out of general overhead, attach them to the right product using your cost drivers, and make decisions that improve both the environment and your bottom line.
All right, final section. Go pass your exam. Final strategic advice.
We have covered a significant amount of high-yield ground today. As we wrap up this revision masterclass, here is your final, absolute, non-negotiable rule. Show all your workings. I mean it. The examiner's reports say this exact same thing year after year. Let's say you mess up one simple calculation early in a throughput question. Well, unfortunately, your final TPAR number is going to be wrong. But if the examiner can clearly see your logic and see that you followed the correct steps, they are going to award you method marks. And believe me, those method marks are literally the difference between a 48% fail and a 50% pass. So please, show your steps. Just think about what we've accomplished today. You now know to completely ignore labor when calculating throughput. You know exactly how to maximize profit per bottleneck hour. You know how to use ABC to expose those hidden environmental costs. You know the models, you know the traps. So, are you ready to apply them and completely crush your PM exam? I know you are. Keep revising, practice those past papers, and go get that pass.
Welcome to this explainer. We're going to completely decode target costing and life cycle costing today to help you absolutely crush your ACCA Performance Management exam. I am so thrilled to have you here. Look, if you've been struggling to connect the dots between strategic pricing and cost management, you are in exactly the right place. We're going to strip away all the confusion, focus purely on the high-yield concepts, and give you the tools you need to approach your exam with total confidence. So let's jump right into it.
Listen closely. Because to really pass PM, you've got to just completely toss out that old-school cost-plus mentality and wake up to a market-driven reality. For decades, right, companies would just calculate how much a product costs to make, slap a standard profit margin on top of that, and push it out to the consumer. Well, in today's fiercely competitive environment, that approach is pretty much a fast track to irrelevance. You don't decide the price anymore. The market decides the price. If you try to charge more than what the consumer is willing to pay, or what your competitors are charging, you simply won't sell anything.
Here's your high-yield roadmap for today's explainer. 1. The pricing paradigm shift. 2. Target costing and cost gaps. 3. Closing gaps with value engineering. 4. Lifecycle costing explained. And 5. The design stage trap.
Section 1. The pricing paradigm shift, from cost-plus to market-driven reality.
The evolution here is crystal clear. The old way was simple. Cost plus profit equals price. But the new way, it changes everything. Price minus profit equals target cost. Now, I know it kind of looks like a simple algebraic reshuffle, but strategically, this flips the entire script. You're starting with the expected selling price, which is that rigid ceiling dictated by the market. From that, you subtract your desired, non-negotiable profit margin, and what you're left with isn't just a suggestion, it's your target cost. It's literally the absolute maximum amount you are allowed to spend to create this product while still hitting your financial goals.
Section 2. Target costing and cost gaps. Finding the villain of our story.
You've got to memorize this definition right now. Target costing is an absolute exam favorite because it essentially forces a business into a corner. Think about it. The price is fixed by the market. The profit is fixed by your shareholders. Therefore, your costs have to adapt. You have to squeeze your operations, your materials, your overhead, all of it, until they fit perfectly inside that target cost box.
If you want to grab maximum marks, you should follow this exact 5-step flow every single time you see a target costing question. First, identify that expected selling price based on the market. Second, calculate your target cost by stripping out your required profit. Third, and here is the big reality check, estimate what the product would actually cost you to make right now with your current processes. Fourth, compare the two to find your cost gap. And finally, step 5, don't just leave that gap sitting there. Recommend actionable value engineering steps to close it.
So, the crucial takeaway is that whenever your current estimated cost is actually greater than that target, you have a cost gap. This is a massive red flag. If you proceed with production while a cost gap exists, you're going to have to either raise your price and lose customers to your competitors, or sacrifice your profit margin, which is definitely going to upset your shareholders. That gap absolutely must be eliminated before full-scale production begins. No exceptions.
Seriously, lock this one-line summary right into your brain today. Target cost equals price minus profit. Cost gap equals current minus target. Repeating this exact phrase over and over will really cement your memory retention for exam day. When the pressure is on, you won't even need to second-guess the math. This simple phrase is going to guide your calculations flawlessly.
Section 3. Closing gaps. Value engineering. The hero that defeats the cost gap.
The examiner is specifically hunting for actionable recommendations here, so use these exact value engineering tactics to strip out costs without stripping out value. Ask yourself, can you make design changes? Maybe using simpler, standard components instead of custom-built ones. Can you substitute for cheaper materials that don't compromise the customer's perceived quality? What about implementing more efficient processes on the factory floor to cut down labor time? Or maybe you can negotiate better with suppliers to reduce waste. This is exactly how you systematically chip away at that cost gap until it hits 0.
Section 4. Life Cycle Costing Explained. The Cradle-to-Grave Strategy.
Unlike traditional absorption or marginal costing methods that obsess almost entirely over just the manufacturing phase, life cycle costing demands that you look at the entire lifespan of the product, literally from cradle to grave. If you only look at the production costs, you're making major strategic decisions while flying completely blind to the massive expenses lurking at the very beginning and the very end of a product's life.
Your mindset has to expand way beyond just the factory floor. Look at this massive spread of time. You've got heavy cash outflows in month 1 for design, research, and development. Then sure, comes production and distribution, but the spending doesn't stop when the customer buys the product. Fast forward to month 24, you might be paying out for customer support and warranty claims. And all the way out in month 60, you could be facing strict environmental costs for disposal, decommissioning, or recycling. If your pricing strategy doesn't account for this entire timeline, your product is ultimately going to lose money.
Section 5. The design stage trap. The locked vault. Okay, I need you to write this number down immediately. 80%. This staggering figure is the absolute key to understanding the relationship between target costing and life cycle costing.
A staggering 80%, sometimes even more, of your total life cycle costs are committed or locked in before you even manufacture a single unit. It's wild. Think of the design stage as this massive, heavy steel vault. When your engineers sit down and decide what materials to use, what shape the product is going to be, and what technology it requires, they are literally deciding your future costs. Once that design vault closes and the product heads to the factory floor, trying to cut costs via Kaizen or simple factory efficiencies is incredibly difficult. At that point, you're just fighting over pennies.
True cost management and true value engineering absolutely must happen early, right at the design phase.
Here is your final high-yield one-liner to memorize for the exam. Lifecycle costing equals cradle-to-grave cost management. It proves that managing performance isn't just about yelling at the production manager to work faster. It actually starts on day one with the design team, and it doesn't end until the product is safely and legally disposed of.
So ask yourself this question when you tackle your very next practice exam question. Are you actively managing your costs up front, or are you just reacting to them after they're already locked inside that vault? Understanding this distinction is exactly what separates an average student from a top-tier candidate. Take control of these concepts, apply them systematically, and go out and absolutely crush your exam. Thank you so much for joining me for this explainer, and happy studying.
Welcome to the Explainer. Let's crush the modern PM toolkit for your ACCA Performance Management exam.
We're tackling 3 high-yield topics today: beyond budgeting, big data's 4 V's, and customer profitability analysis. First up, a huge problem. Are rigid, traditional annual budgets actually driving dysfunctional behavior in businesses?
The fix? Ditch those fixed constraints entirely. We're moving toward beyond budgeting and its agile, rolling forecasts. This totally crushes budgetary padding. It stops system gaming and actually encourages real, continuous improvement.
But heads up, ditching fixed budgets demands high transparency, strict accountability, and a super mature management culture.
Next is big data. These massive datasets are literally the fuel for predictive, real-time performance management.
You gotta memorize the 4 V's for the exam: volume, velocity, variety, and that crucial quality, veracity.
All this data directly powers real-time dashboards and our final critical tool, Customer Profitability Analysis, or CPA.
Now here's a totally counterintuitive fact you need to remember. Not all customers are actually profitable.
CPA exposes the massive gap between a customer bringing in high revenue versus actual bottom-line profit.
To find that true profit, you've got to allocate hidden costs, like order processing, delivery, and returns.
The math proves it. An 80,000-pound revenue customer could seriously end up losing you $3,000.
So take strategic action. Raise those prices, enforce minimum order levels, or push cheaper direct channels.
Exam trap alert. Don't just calculate the data. You must recommend real, actionable commercial fixes. Ask yourself, do your performance metrics actually capture true value, or are you just counting costs?
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this masterclass explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy.
Let's kick things off with Section 1, ultra-fast revision.
All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom, adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in.
Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit. and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately.
Now, let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental. You know, the examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on.
Let's keep this intense pace going. Notice how quickly we can switch contexts here, just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BAR-DR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be.
So, why do good students fail ACCA exams? Think about that for a second. I mean, they know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now.
Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out.
Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value.
Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you.
If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank.
Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this.